In a word, yes, I think it can, for sure. The current low level of FX volatility began in January, so we're in or around the 3-month period. Looking back at previous historic examples in 2014 and in 2006 and 2007. In 2006 and 2007, it lasted about 10 months. In 2014, about 7 months. Both of those occasions, it was a very big global macro event that brought that low FX volatility to an end. In 06-07, of course, the great financial crisis. In 2014, the beginning of the crude oil price crash, and then the implementation of quantitative easing from the ECB in January 2015. So we're 3 months in. So really it's potentially going to take a big global macro event to bring this current period of low FX volatility to an end. And certainly from historic perspective, it can last for many more months to come yet. I'm not convinced, to be honest. Again, that low FX volatility that began in January, that's on a G10 basis. Through much of this period, we've actually had very high sterling volatility. And that was, of course, in the run-up to the initial deadline for Article 50 on the 29th of March. And then it was only after the extension until the 31st of October that pound volatility has come down very sharply. So in other words, we can live with high sterling volatility and very low G10 FX volatility. Right now, we're in a situation where, as you can see here, the pound is beginning to drop, and that's on concerns that the cross-party talks between the Tories and the Labour Party could be about to collapse. If that happens, it brings forward the potential of a leadership election in the Tory party for a new Prime Minister and potentially a general election. So I think there's a high chance we could see sterling volatility come back up, but whether that transmits into broader, higher G10 FX volatility, I think is very questionable. Well, talking about a major macro event, if there's something on the immediate horizon, I think certainly the collapse in US-China trade talks is the biggest immediate risk. Obviously, we've had the tweets from President Trump suggesting an implementation of higher tariffs on China imports, and that obviously results potentially in the collapse of these negotiations over the short term. Very clearly, equity markets are priced for a deal being done. Chinese equity markets, the US equity markets, and broadly equity markets have performed very well, in part on the hope of a deal being done. So if we do get a breakdown in these talks, then equity market volatility is definitely going to pick up, and very likely that will transmit itself into FX volatility as well. So while it's not a major macro event on the scale of what happened in 2014 and 2007, it certainly has the scope for lifting FX volatility over the short term.